morning or afternoon, everyone, and welcome to the ASC Topic 606 5 Steps presentation with examples about revenue recognition, Part 1, webinar presented by Hein and Associates. We are pleased to offer complimentary webinars each month that cover a wide range of finance and accounting topics. I'm Shannon Reddy, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature. We will save time at the end for Q&A as well as answer questions throughout the presentation. This webinar is being recorded. A copy of the webinar presentation and its recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this, you will need to be connected for a minimum of 100 minutes and answer 75% of the polling questions that are included throughout the presentation. Immediately following this webinar, you will be directed to an online evaluation form that must be submitted in order to receive your CPE certificate for the course. Please check your inbox later today for a follow-up email that will include a link to the evaluation as well. Our presenters today are Greg Fall and Michelle Carr, both partners in our Denver office. Greg provides a wide range of audit and accounting services for both public and privately held companies. He assists clients with financial reporting and complex transactions, such as initial public offerings, IPOs, private offerings, and mergers and acquisitions. He has extensive experience in debt and equity finances, share-based compensation, income tax accounting, purchase price accounting, and SEC reporting. He focuses in the alternative energy, technology, and manufacturing and distribution industries. Michelle began her career in public accounting with Hein and Associates in 1999. Since that time, she has primarily worked with technology and software firms, manufacturing distribution companies, and clients in the mining sector. Michelle served both privately held companies and publicly traded corporations, overseeing a variety of assurance engagements and consulting projects. Her assurance work has ranged from audits for SEC and IFRS engagements to due diligence services and other agreed-upon procedures. In addition, Michelle provides technical support on complex accounting issues, advises on revenue recognition, inventory, as well as the matters of impairment, goodwill, and mergers and acquisitions transactions. We thank you for attending today, and I would now like to introduce Greg Fall and Michelle Carr.
Okay, thank you, Shannon. To get us started, I thought it would be a good idea to talk a little bit about our revenue recognition webinar series, as this is a different format than what we have traditionally done in our webinars. Kind of background on that, these new revenue recognition standards, and I'll call them standards because they do trickle around some of the other codification areas beyond just Topic 606, likely would be some of the most fundamental changes that I've seen in my 20 years of practicing. They also are likely going to affect virtually all companies. And the content of that, we wanted to make sure that we are providing a robust discussion and background in order for companies to implement these standards. Also, we realize that companies are going to be in various places as to where they are in the implementation process, which we'll talk about in just a minute. So for today, in the first part of the webinar series, we're going to cover really the first 3 steps in what we'll see as a 5-step process for revenue recognition. The second webinar is going to be a continuation of the 5-step process. We'll also cover disclosure requirements, contract costs, and then other miscellaneous topics. In the third webinar, we plan to talk about lessons learned from early adopters Potential audit changes, what to expect from your auditors, which is a big question out there in the finance community right now.
For some reason, no one can hear the audio right now at all. It's not like. They can hear. Okay, you're good, actually. Sorry. Sorry, great, continue. Sorry, for those attending, if you are on the phone, can you please turn up your volume, as it should be working on both your computer or phone right now. We're receiving a few questions about both. So, sorry about that.
So no need to start over?
No need to start over.
We're
just having a few people come in with audio issues, more than normal. So, sorry, Greg, continue.
Okay, so then, and just to finish up in the third webinar, we'll talk about also John Monahan, one of our tax partners, will talk about some of the changes to income tax accounting, because obviously a change to revenue recognition will have impacts to any ASC 740 income tax provisions. And then in our fourth webinars, we're going to have our technology management consulting group talk about accounting system changes as a result of the implementation of Topic 606. So that is the way we've organized it, and really, again, just because of the volume of information here, we felt like that was a good approach to make sure everybody has an opportunity to get as much out of this as possible. So with that, let's jump into the revenue recognition standard, and natural place to start is, when are the effective dates? We've got a polling question first.
Yeah, we have a polling question first. So we're going to start there, which is for the attendees. If you could please answer the question here. Where are you in the process of adopting the new revenue recognition standard? Having considered how to apply, assessing the impact, developing documentation/conclusion, or working on adapting systems ready for implementation date. Please make your selection now. All right, thank you very much.
Okay, so it looks like most of you are in the process of assessing the impact of the standard. Developing documentation and conclusions. So good to know where everybody is in the process. Like I said at the onset, we understand people are going to be in different places here. And one of the reasons for that is the implementation time frame. So if you are a public business entity, the effective date for a calendar year public company will be periods beginning after December 15th of 2017. So put that in perspective, that is Q1 of 2018, which is very, very quickly approaching. So the actual words are for reporting periods beginning after December 15th, 2017. So you have to think about if you're not, fiscal year end, something other than 12/15, you have to figure out where we fall in that time frame. Generally, for all other entities, the implementation date is going to be 1 year later. So again, for private companies, this will be effective for December 31st, 2019 financial statements, unless you report quarterly results somewhere within there. Early adoption is only permitted as of the original effective date for public companies. At this point, that is not as relevant, because That was a result of a one-year push-out that really was driven by the SEC, and the FASB adopted it. So technically, public companies could have adopted the standard, again, on a calendar year basis, could have adopted as of the beginning of this year. So then let's talk a little bit about transition methods, and you can see the slide here. We talk about full retrospective method or a modified retrospective method. So both approaches are a retrospective method, and in general what we could say is under the full retrospective method, you're going to apply the changes and recast your numbers for all years that are presented in your financial statements. So for instance, a public company that is not a smaller reporting company required to present 3 years of income statements with an adoption date of January 1 of 2018, you would present 3 years of income statements. So that would be 2018, 2017, and 2016 would need to be restated to present under the new guidance. Under the modified retrospective method, there are no restatements to the previously issued numbers, but you present a cumulative effect catch-up in your retained earnings as of the beginning of the period of adoption. So that's basically the difference between those two transition methods. So let's talk a little bit about the full retrospective method. I think I covered a large part of this already. But there are some practical expedients that have been provided. Those practical expedients, contracts that begin and ended within the same annual reporting period, completed contracts with variable consideration, you can look to the final transaction price to use that as opposed to trying to determine what your estimate would have been at the beginning of that contract. Another practical expedient is able to reflect the aggregate of all modifications that occurred before the beginning of the earliest period presented. So we'll talk about modifications here in a few minutes, which will make that one a little bit more clear. Entities would not need to disclose the amount of the transaction price allocated to remaining performance obligations and an explanation of when the entity expects to recognize revenue for periods presented before the date of the initial application. Then to the modified retrospective method. Key point here is that there are additional disclosures that are required if you choose to utilize the modified retrospective method. And those additional disclosures are the amount by which the financial statement line item is affected in the current reporting period by the application of this update as compared to the guidance that was in effect prior to the change. And then an explanation for the reasons for the significant changes. Ultimately, what that means and kind of the drawback to that is you really have to keep two sets of books. And I know as auditors, we never like to hear about two sets of books, but this would be the occasion where you have two sets of books because you do have to present what the effect on the prior years would have been in your footnotes. The other core element in how to make a decision here is, do you have revenue that potentially would be lost if you choose the modified retrospective method? And we're going to go through an example of how that may take place here in just a few minutes when we get into the examples. But ultimately, if you think about whether you have deferred revenue on the books as of the date of implementation, particularly companies in the technology industry, that this could come into play where because of the adoption, because of utilizing a modified retrospective method, revenue that would have been recognized basically gets plugged into the retained earnings cumulative effect instead of being recognized in revenue. So a lot of CEOs may not like that. So that may be a reason not to go that route. So just go ahead and walk through an example of how that could come about. And I don't have a slide for this one. It's just I'll talk through the example. So assume we have a software company that sells a license for $1 million. And as part of the contract, they agree to provide ongoing support for 3 years. Assuming there's no VSOE, VSOE is, for those of you not in the technology world, that's pretty specific to technology companies, but vendor-specific objective evidence. Assuming there's no VSOE for the support, the revenue would have been deferred and recognized in total over that 3-year period. So under legacy GAAP, the entire contract is recognized over 3 years, which would have left some deferred revenue on the books for that contract, presumably at the date of implementation. Under Topic 606, the new revenue recognition standard, the company determines, which likely would be the case, that the license should be recognized separately for $800,000. And as a result, that $800,000 would have belonged to a prior period, and a portion of that would have been caught up in the cumulative effect change in accounting principle rather than being recognized in revenue. The way around that is full retrospective method, where you'd recast your prior numbers and present the revenue as if it were recognized in that time frame. So a few statistics. These come from Audit Analytics, which is a tool that we subscribe to as a firm. But it's interesting to get in and see what's going on out there with the public companies, which Audit Analytics primarily is focusing on public companies. That's their data source. So how are companies going to adopt this standard? And currently, what we're seeing is under the full retrospective method, 51 companies are planning to apply that, whereas 217 companies are planning on the modified retrospective method. Then another 230 companies are undisclosed as to which method they're going to apply. So certainly the majority are going to the modified retrospective method, seemingly easier not to have to go back and recast all the prior years.
Perfect. And now we have our next polling question. Which transition method has your company determined to be best for the organization? Remains undecided, modified retrospective, full retrospective, not planning to make any changes. Please make your selection now.
So it looks like we're kind of fitting in with the Audit Analytics. There's a whole lot of undecided still out there, but the modified retrospective is certainly outweighing full retrospective. Okay, so let's jump in from there into the new standard and what it means. So I think an important place to start is, what are the objectives? What was the FASB and the IASB? What are they trying to accomplish with this pervasive change to accounting for revenue? So as you get into, and we try to provide actual codification topic numbers as possible here. So at times, if we're doing that, it's really so that, hopefully you have a resource material you can go back and look at. But in 606-10-10 is the objectives of the new standard. And that objective is to establish principles that an entity shall apply to report useful information to users of financial statements about the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract. In order to meet this objective, the core principle of the guidance in this topic is that an entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So a key difference here, if you look at the slide, under legacy GAAP, really was a risk and rewards approach for revenue recognition. Under topic 606, it's really looking at transfer of control to the end customer. And that's what's driving the revenue recognition, is transfer of control. The other core concept here, I would say, and we'll get into during this part of the presentation, is the amount of consideration that the entity expects to be entitled. Generally, the FASB is under the presumption that we can estimate how much revenue will be a part of, will ultimately be recognized as part of this contract. There are some constraints. We'll get into that very, very shortly, but key difference is that the expectation is that generally we can estimate the amount of revenue. So a few of the scope exceptions on the next slide, just kind of run through this pretty quickly, but where the standard does not apply is to lease contracts, insurance contracts, financial instruments such as derivatives, guarantees, and non-monetary exchanges between entities in the same line of business to facilitate sales to customers. And then on, I think, next slide, got to understand with this standard, it really is superseding. If we think about the old how we account for revenue recognition currently, standards really have been all over the place. Actually, in the old days prior to the codification, you had to go to, maybe you were going to AICPA statements of position, an example of construction contractors, even software companies. It resided in all these different locations. With this new standard, it really is replacing substantially all of the previous revenue recognition guidance. On the next slide, I just want to list some of the other resources to be aware of for you. The Joint Transition Group for Revenue Recognition, the TRG. This is a group that was established when the standard initially came out. I think technically they are supposed to be done with their meetings at this point in time, but they've been going through different implementation issues and reporting back to the FASB. As a result, we've seen a lot of ASUs that have been issued in order to update the guidance. The SEC Office of the Chief Accountant, particularly in regards to SABs, Staff Accounting Bulletins. As some of you may be aware, there's topic 13 out there in the Staff Accounting Bulletins that deals specifically with revenue recognition. There have actually recently been some changes to that as a result of the standard, so another place to keep in tune with. The AICPA has various industry task force that are approaching and deliberating various concepts as they relate to various industries. By and large, those are hitting in the form of accounting and audit guides as they're getting resolved. So then let's move to the core concept of revenue recognition. So as I alluded to earlier, this is really a 5-step process. And we'll go through them 1, 2, 3, 4, 5, basically. But another important concept to understand is this is not necessarily a linear process. So you may be tackling 1 or 2 of these at the same time, different orders, et cetera. But the 5 steps: number 1, identify the contract with the customer. Step 2, identify separate performance obligations. Think in terms of multiple deliverables under old GAAP, legacy GAAP. Step 3, determine the transaction price. 4, allocate that transaction price. And step 5, recognize the revenue when performance obligation is satisfied. And with that, we're going to jump into step 1, which is identifying the contract with the customer. That may seem, on its surface, relatively straightforward, but certainly there are exceptions to that. So a contract is an agreement between 2 or more parties that creates enforceable rights and obligations and meets all of the following criteria. The contract has been approved, and the parties are committed to perform their respective obligations. Each party's rights regarding the goods and services can be identified. The payment terms for the goods and services can be identified. The contract has commercial substance, and it is probable that the entity will collect the consideration to which it will be entitled in exchange for goods and services that will be transferred to the customer. So if you think in terms of so that last one, under legacy GAAP, and in particularly SAB Topic 13 that I mentioned previously, one of the requirements for revenue recognition is that collectibility needs to be reasonably assured. So this is where that falls in to the new guidance. So it's part of whether a contract exists with the customer. So if collectibility is not reasonably assured, although using different terminology and a little bit different concept, then we do not have a contract with our customer. The other tricky element here may be in the first bullet as to when do you really have a contract. And this is where, honestly, we may need to get the lawyers involved to determine, because sometimes actually just individual state laws may change this. But in the standard, it says that it may be in writing, orally, or in accordance with other customary business practices. So, key point, it doesn't have to be in writing. You don't have to have a formal contract for it to be considered a contract under the standard. So what is a customer is another important definition. The customer is a party that has contracted with an entity to obtain the goods or services that are an output of the entity's ordinary activities in exchange for consideration. We have an example on that one. When we move into the examples, we'll go through that so we can understand exactly when somebody may not qualify as a customer, and I think that one will become more clear. Then let's talk about the unit of account. The unit of account is each individual contract with the customer, and this certainly has as this standard came out, certainly created some level of debate as to, do I have to go through every single one of my contracts, every one of my customers? There is a practical expedient that has been provided that you can group contracts into portfolios of contracts if the entity reasonably expects that the effects of on the financial statements of applying this guidance would not differ materially. So a bit of judgment. There's a lot of judgment that's going to take place in applying these new rules. But again, if as a company you can get to the point of making that determination, you can take the practical expedient and group your contracts and apply the standard to that grouping of contracts. Another key concept is, when do we have to combine contracts? And the FASB put this in here, basically realizing that in some cases the timing of recognition may differ if a company were to account for contracts that were entered into at or near the same time, were accounted for as separate contracts versus combined as one contract. So we've got here the rule for combining contracts. They have to be entered into at or near the same time with the customer and account as a single contract if one or more of the following criteria are met. The contracts are negotiated as a package with this single commercial objective. The amount of consideration to be paid in one contract depends on the price or performance of the other contract. Goods or services promised in the contract are a single performance obligation in accordance with 606.10, 25.14 through 22. Let's quickly talk about contract modifications, and then I think we're going to jump into a few examples of step one. So contract modifications, this is a change in the scope or price or both of a contract that is approved by both parties to the contract. So the question is, how would you account for a contract modification? You account for the modification can be accounted for as a separate contract if both of the following conditions are present. The scope increases because of the addition of promised goods or services that are distinct. And that concept of distinct is going to be talked about in step two, which is forthcoming. So don't worry about that just yet, but understand that all these concepts will kind of tie together. And secondly, the price of the contract increases by amount of consideration that reflects the entity's standalone selling price. So if both those conditions exist, then the contract modification can be accounted for as a separate new contract. So with that, let's jump into a few examples. I will say most of these examples we pulled directly out of the implementation guidance. So in addition to what we have here, you should easily be able to go into topic 606 and then into the implementation guidance. They have, oh gosh, probably over 60 or 70 examples in there. So there's a lot of good reading material. So the first example is determining if the counterparty is a customer. And as I mentioned, this may not always be straightforward. The example provided here is a bioscience company that enters into a collaboration agreement with a pharmaceutical company. So determine if the pharma would qualify as a customer. Bio is to provide goods or services which could include licenses to certain intellectual property rights and/or research and development. And pharma is to pay consideration in exchange for those goods or services. So in that case, pharma would be a customer. Alternatively, the contract may be more akin to a partnership or collaborative arrangement than a contract with the customer, and lined out some specifics down here, some examples down here as to what may cause us to conclude that. So bio and pharma agree to co-promote a developed product and share profits. Pharma agrees to cover some of bio's marketing expense. The collaboration partner is not a customer since the counterparty is not receiving goods or services in exchange for the payments. And as a result, the contract is outside the scope of Topic 606. Next example is an example where under legacy GAAP, the item would not qualify as revenue, but under Topic 606, it does qualify as revenue. So in this example, again, with a technology company, there's a funded software development agreement with the customer. Assuming technological feasibility was established under ASC 985-605, any payments received first have to be netted against capitalized development costs. Whereas under Topic 606, this contract would be considered a contract with a customer, so likely all of the cash receipts on that would be recognized as revenue as opposed to a reduction in the capitalized development costs. Collectability, as I mentioned, this is moved into the step one, and it's somewhat of a rather long example, but ultimately we've got a real estate developer entering into a contract with the customer for sale of a building of $1 million. The customer is going to open a restaurant. It's located in an area with high competition, and the customer has limited experience in the industry. Customer pays $50,000 at inception and enters into a financing agreement for the remaining consideration. Key point, that is non-recourse. Company ultimately concludes that the criterion in 606-1025-1E is not met because it is not probable that the entity will collect substantially all of the consideration. The following factors were key to the conclusion. So the company looked at the fact that the payments on the loan will primarily be derived from the restaurant, which is a business facing significant risk. Customer lacks other income assets that could be used to repay the loan. And the liability under the loan is limited because the loan is non-recourse. And with that, we'll move into, do we have another polling question?
We do.
Okay.
Question 3, what will be the most difficult about identifying if a contract exists? There will be no difficulty determining if we have one or multiple that can be combined for each customer, assessing contract modifications, determining if the counterparty is a customer. Please make your selection now.
Okay, so it looks like for the majority of folks, assessing contract modifications is going to be the key point, and then combination of contracts being second there. So,
and we also have a couple questions that came in during step 1. Question being, is there any benefit of early adoption?
The benefit, the companies out there that have early adopted, and probably the benefit of doing so, if you think about software companies in particular, that's the easiest example I can think of, where your revenue would be recognized sooner under the new standard than it would be recognized under the old standard. That would be the benefit to early adoption. Outside of that, I really can't think of much.
Okay.
And there have been very, very few companies early adopt.
Okay, good to know. Next question. If we have no material amounts of deferred revenue at the time of adoption of the standard, is there a difference between full retro method and modified retro method?
Certainly will be much, much less difference, but we'll still need to go through and identify the contracts, make sure there's no differences that would result in difference timing of cost, for instance, may be a difference. And in the second webinar, we're going to get into some of the changes with how to account for cost, but generally, probably pretty safe.
Okay. Thank you for your questions. We will now be moving on to step 2. Okay, moving into identifying performance obligations in the contract. So historically, companies oftentimes sell multiple goods or services in a single transaction or in a single contract. Historically, we've had this multiple element arrangement guidance that has been superseded with 606. So that we're going to still have to go through and identify those individual performance obligations within those individual contracts and kind of unbundle those items, as well as the fact that if you've historically had a situation where you had one good or service that you reported revenue under, there is a potential that one particular item needs to be broken down into multiple performance obligations as well. So consider that in your assessment. So the first thing that we need to really do is consider scrutinizing our contracts pretty heavily and really determining what all the promises are in the contract. Ultimately, you're trying to identify what the performance obligations are in the contract to be reported separately. So in order to take a promise to that level, you really are going to have to assume you get to a stage where they're both or either distinct or a series of distinct goods or services that are substantially the same and have the same pattern of transfer. So in some situations, some of the promises will be easily identified. So if you provide cleaning services, let's say, that's going to be probably very easily identified. If you have situations where you are selling the right to software upgrades or an option to purchase items in the future at a discount, those items may become more difficult to clearly identify. So the codification has given us certainly some examples, and I think it's important to go through some of these and just make sure that we all have our head around this a little bit before we move on. So I'm just going to kind of list these and go through them. So the sale of goods, the resale of goods, resale of rights to goods and services, performing a contractually agreed upon task, providing a service of standing ready to provide goods or services, providing a service of arranging for another party to transfer goods or services, granting rights to goods or services, constructing, manufacturing, or developing an asset, granting licenses, and granting options to purchase additional goods or services. So what about shipping and handling costs? How do we handle those? Are those a separate promise within the contract? There is specific guidance that addresses that. So if shipping and handling activities are performed before the customer obtains control of the good, your FOB destination situations, then shipping and handling is typically not a promised service to a customer. It's really treated as part of the fulfillment activities and not considered a separate promise needing to be evaluated under 606. However, you can make an election to account for shipping and handling as activities to fulfill the promise to transfer the good if you have FOB shipping point or the shipping and handling occurs after the customer obtains control. I did want to point out, if you have that situation, it's likely you're going to need to accrue the costs associated with that when you do recognize revenue, because the revenue will follow the transfer of control, so it will likely happen prior. As a cautionary note, you're not required to assess immaterial items as performance obligations unless there are multiple items that are individually immaterial but combined are significant, in which case they can't be ignored. So you'd have to break that down and identify enough performance obligations to the point that what is left remains combined insignificant. So let's clearly state what the new principle really is. It says the seller should identify any performance obligation within a contract, then allocate a portion of the total contract price to each distinct performance obligation. So if there's more than one promise to transfer goods or services, consideration is going to need to be given as to whether the promises to transfer goods or services should each be a performance obligation or treated separately. So we've mentioned this word distinct over and over, so let's talk about what really qualifies as distinct. You have to meet both of these criteria. So is it capable of being distinct? So is the customer can benefit from the goods or services either on its own or together with other resources that are readily available to that customer. And another consideration in that is, do we sell this item separately? Does a competitor or somebody else in our space really sell those items separately? And then additionally, is it separately identifiable from the promises in the contract? That is, the promise to transfer the good or service is distinct within the contract. So those promises have to be clearly identified within that contract. And just as a reminder, really identifying whether these items are distinct and meet performance, the criteria for performance obligations really should be done at the onset of the contract or the signing of that contract. Answering yes to any of these following items is an indication that the promised good or service is not separately identifiable from the promises in the contract. So let's just kind of clearly go through those. The seller provides a significant integration service that results in a combined output, or one of the promised goods or services significantly modifies or customizes another good or service in the contract. Goods or services are highly interdependent or interrelated. So let's go through an example to talk about that a little bit more. So this first example is really in regards to goods and services that are not distinct. So an entity, a contractor, enters into a contract to build a hospital for a customer. The entity is responsible for the overall management of the project and identifies various promised goods and services, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of the equipment, and finishing. So are the goods and services are capable of being distinct? So the customer can benefit from the goods or services either on its own or together with other readily available resources. So I think if you consider each of those phases that is being accomplished, the customer could contract with another provider to move forward with those and finish the project. The customer could generate economic benefit from the individual goods or services by using, consuming, selling, or holding those goods or services. So I think we could all agree that there is economic benefit there. But are the promises separately identifiable in the contract? And they're not. Since the entity provides a significant service of integrating the goods or services or considered the inputs into the hospital, the combined output for which the customer contracted. So they really contracted for the hospital. They didn't contract for foundation and the piping and the wiring and those individual items. They're looking for a combined output. And so because that criteria is not met, the goods and services are not distinct. The entity would account for all the goods and services in the contract as a single performance obligation. So I posed the situation in that the situation might be slightly different had they contracted to produce both a hospital and a parking structure, because those are probably both individually capable of being distinct and separately identified in a contract likely. So I throw that out there because I don't think that potentially those two structures wouldn't be interrelated or dependent on each other. So let's look at one more example. An entity, a software developer, enters into a contract with a customer to transfer a software license, perform an installation service, and provide unspecified software updates and technical support for a 2-year period. The entity sells the license, installation service, and technical support separately. The installation service includes changing the web screen for each type of user. The installation service is routinely performed by others and does not significantly modify the software. The software remains functional without the updates and the technical support. The entity in this situation determines that the promise to transfer a good or service is separately identifiable. And then although they are performing some integration services, they believe this to be more of a routine service and that the software really could function without it, or they could have that done separately. The software updates do not significantly affect the customer's ability to benefit from the software license. So we're talking about likely just a box software package. None of the promised goods or services significantly modify the customization of one another. And the entity is not providing a significant service of integrating the software and services into the combined output. So at the end of the day, the conclusion is the software and services do not significantly affect each other, and therefore they're not highly interdependent or highly interrelated, because each of those promises can be delivered separately. So they basically have identified 4 performance obligations: the software license, installation, software updates, and the technical support. So I would like to mention one last item on performance obligations, and that Greg mentioned it earlier, but there is a practical expedient where it may be applied against a portfolio or similar performance obligations across multiple customer contracts if it is not reasonably expected to result in a materially different outcome. So this is where that would apply. If you are selling widgets, for example, and you have the exact same contract for each customer, although this revenue guidance is specifically meant to be applied on a contract-by-contract basis, they are giving you this practical expedient to work with. Or if those contracts are just are very similar, but might have some slightly different changes that wouldn't have a material impact, you could consider those identified as well.
We now have our next question. Do your contracts indicate promises that are separately identifiable? Yes, no, no, possible to clarify contracts.
So, can I look at those results again? So do your contracts indicate promises that are separately identifiable? So in this situation, it looks like you guys are starting to assess that, and you do realize that, that there are going to be multiple items there.
Okay, and we had a question come in during that part of the presentation. What about customization? Doesn't that require that some items are not distinct, still to be recognized over time?
Can I see the question again?
Oh, okay. So what about customization? Doesn't that require that items that are distinct still be recognized? And then it says not distinct. If you have separate performance obligations and they're identified separately, I mean, you're going to have different methods of revenue recognition attached to each of those items. So if it is something that is being recognized over time, you'll have an opportunity to do that separately from the other items that are a true immediate transfer of a good or service. You think I've answered? Okay.
Mm-hmm.
Yeah. Hopefully that answers your question.
Yeah, so when we get into step 5, we will talk about how revenue is recognized at a point in time versus over time.
Mm-hmm.
And with multiple performance obligations, the separate performance obligations could be recognized in a different manner. I think that's just to recap what you just said, basically.
Yes. Thank you.
And we had another question come in. In the software example, what would the treatment if it was customized in-house software? I don't know if I'm. If you're set, I can't. Thank you. What would be the treatment if it was customized in-house software? Well, this is the only thing that 606 applies to is contracts with customers. So if it's internal, that's going to fall under separate guidance. Am I missing anything in that statement?
I'm just not sure I understand fully the
Yeah.
question, because if it is internally developed software for sale to a customer, that would be under scope, in scope. Internally developed software for internal use would be out of scope.
Right. So I'm not sure which situation we're referring to here, but if you had customized in-house software that you were reselling, you would still, you would have those separate performance obligations within the contract, and you would recognize it when the transfer of that license is transferred to them. I think your question may be the underlying cost associated with that, but I'm not clear. So if you want to send in more information or ask a question on the back end or to us directly, I'm happy to follow up with that.
Yeah, we can also get back to individuals on any of these questions where further clarification will be needed, or feel free to reach out to us as well. Is that all the questions?
That is.
Okay. So then moving on to step 3, which is the determination of the transaction price. Again, what seemingly may seem relatively straightforward likely will not be. And when we get into the concept here of variable consideration, I think that will become clear as to why. So as part of determining the transaction price, the entity should consider the effects of the following. Variable consideration, which I just mentioned. Well, what is variable consideration? We'll get into examples of what that may be. Constrained estimates of variable consideration. On its own, that seems very difficult to understand, but we'll show that to you in a moment. I will tell you that is a very critical concept within the standard that really is pervasive all the way throughout the standard. So it brings in a probability approach that has to be met in order to really recognize revenue. Existence of a significant financing component, non-cash consideration, and then consideration payable to the customer. Again, we'll get into examples of these as we go through the materials. So first, for variable consideration. Again, we've got the codification site here, but an amount of consideration varies because of discounts, rebates, refunds, credits, price concessions, incentives, performance bonuses, penalties, or other similar items. It can also vary if part of the consideration is contingent on the occurrence or non-occurrence of a future event. For example, amount of consideration would be variable if either the product was sold with a right of return or a fixed amount is promised as a performance bonus on achievement of a specified milestone. So I think from within just this one paragraph, we can see here that there are a lot of factors that could cause the consideration to be variable, and we have to determine what to do with that variability. I said early in the introductory section that the general concept, the general belief is that we should be able to estimate that, correct? And that's generally what is going to happen here. So when estimating the amount of variable consideration to include in the transaction price, another important concept is to look past these stated terms and consider the practices of providing refunds or concessions or the intentions of the seller and potentially providing rebates or other credits to the specific customers. So what this is saying is just because you have a contract that states that there's none of these items, no variability, for instance, that may not necessarily mean that there is no variability in the pricing. So you do have to look at past practice and make that determination. And in part 3, when we talk about what's going to be important to the auditors, well, you might guess this is going to be an area that is fairly judgmental, and that we as auditors will need to look at it. Is there a past practice of providing this form of variability in the pricing? So, I guess a little bit of a prelude to part 3 here, but that is yet another area of significant judgment. So how do we estimate variable consideration then? And apologize for the small print, so don't worry about necessarily reading it, but basically there's 2 methods of estimation, the expected value and the most likely amount. Expected value is basically a probability-weighted estimate of what the consideration will be. The most likely amount is the single most likely amount in a range of possible outcomes. So where the most likely amount would probably be most applicable would be if you have variability that has 2 possible outcomes, and you could look at it and say this one outcome is the most likely one over the other one, so we would choose the most likely amount. Expected value is more appropriate when there's a large number of contracts, similar characteristics, multiple outcomes. So then I mentioned the constraining estimates of variable consideration. And that sentence, I guess, or phrase, I guess, seems a little difficult to understand, but really all we have to think about is probability, which we're all used to in accounting standards going back to FAS 5 with accounting for contingencies, which really still exist. And probability and the concept of 606 would be defined in the same fashion of anything greater than 50%. So 50.1% is probable. So what this is saying is in order to utilize the company's estimate of variable consideration, it has to be probable that a significant reversal in the amount of cumulative revenue will not occur when the uncertainty associated with the variable consideration is subsequently resolved. So it's kind of long, I'm just going to repeat it. So probable that a significant reversal in the amount of cumulative revenue will not occur when that uncertainty is resolved. So again, just a probability, kind of a safeguard to put on there. Perhaps you prevent abuse or whatever, but again, this concept does flow into many different aspects of the standard. So next topic within the step is consideration payable to a customer. So what is consideration payable to customer? And depending on your industry, you may or may not be used to this, but really I don't think there's a fundamental change here for the way it's been defined in the past. My most likely example would be like co-op advertising fees, and but what consideration payable to a customer is defined as cash amount that any entity pays directly to the customer, but it also includes credits or other items, examples being coupon or vouchers that can be applied against amounts owed to the entity. For example, they take a credit directly against their accounts receivable and just reduce the amount that gets paid to satisfy the amount that they owe us as the seller. So the entity shall account for consideration payable to the customer as a reduction of the transaction price and therefore of revenue, unless the payment to the customer is in exchange for a distinct good or service. And Michelle covered the word distinct in step 2, and here it is popping back up again, because unless you can qualify what you're receiving for that payment to the customer, ultimately you're getting to a net revenue presentation. And that is, again, as an auditor, I've had some tough conversations as to when the revenue should be recognized net, such as in these examples, versus gross. And typically it has been very, very difficult to get to a point of recognizing as gross. Not sure this necessarily is going to change things really, but you've got a different framework in which to look at. So now we're going to be looking back at step 2 to determine if we've got a separate performance obligation or a distinct good or service that we're receiving in order to recognize that as an expense and recognize revenue as gross. And the second bullet there is, again, just the constraint for variability in the case of, or constraint for probability in the case of variable consideration. Okay, so with that, I think we're going to move into some examples. Step 3. The first one deals with right of return. So in this example, an entity enters into 100 contracts with customers. Each contract includes the sale of one product for $100. So total consideration of $10,000. Cash is received when control of the product transfers, and the entity's customary business practice is to allow a customer to return any unused product within 30 days and receive a full refund. The entity's cost of each product is $60. So the entity applies the guidance in this topic to the portfolio of 100 contracts because it reasonably expects that, in accordance with 606-10-10-4, the effects on the financial statements would not differ materially from applying the guidance to the individual contracts within the portfolio. So basically just allowing them to take a portfolio approach. Because the contract allows the customer to return the products, the consideration received from the customer is variable. So again, it's just because you've got a right of return, the ability for the customer to return the product, that creates the variability that we were discussing at the onset of step 3. So to estimate the variable consideration, the entity decides to use the expected value method, which is a reminder that's the kind of probability weighted approach, because that's a method that the entity expects to better predict the amount of consideration to which it will be entitled. Based on that, the entity estimates that 97 products will not be returned. So basically you'll get a return of 3 items, but 97 will be sold. This next slide, again, I apologize for the small words here, but or small fonts here. A lot of words, small font. But really what this is getting into is our constraining estimates of variable consideration popping up yet again here. Ultimately, they are deciding that because they have significant experience in estimating returns for this product and customer class, and also that the uncertainty will be resolved within a short time frame, the entity concludes that it's probable that a significant reversal in the cumulative amount of revenue recognized will not occur as the uncertainty is resolved. So the probability threshold in this example is passed. And so then what do we do with, how do we account for this? So upon the transfer of control of the 100 products, the entity does not recognize revenue for the 3 products that it expects to be returned. And here is the journal entries for which they'll record the revenue. So you got revenue in the amount of $9,700 instead of $10,000 because we're expecting the 300 to be returned. Again, that's that net revenue concept. You're going to record a liability for the $300 estimated to be returned. Cost of sales and inventory is going to also account for the 97 items in cost of sale, create an asset for the cost component of the 3 items that are going to remain that are expected to be returned. So that gives us an example of how to deal with right of return, just one example of variability within the transaction price. Price concessions then is another example. So in this case, the entity enters into a contract with the customer, which is a distributor, and transfers 1,000 products at contract inception for a price stated in the contract of $100 per product. Payment from the customer is due when the customer sells the product to the end customer. The entity's customer generally sells the products within 90 days of obtaining them. Control of the product transfers to the customer on December 1, 2000X7. So in case A in this example is an example of where variable consideration is not constrained. So in this case, the entity has significant experience selling this and similar products And the observable data indicate that historically the entity grants a price concession of approximately 20% of the sales price for these types of products. Current market information corroborates that a 20% reduction in price will be sufficient to move the products through the distribution chain. Also, the entity has not granted a price concession significantly greater than 20% in many years. So in order to estimate the variable consideration, they're using the expected value approach, which is a probability-weighted approach, because that's a method that it expects to better predict the amount of consideration to which it will be entitled. And using this approach, the entity estimates the transaction price to be $80,000 instead of the $100,000 that was originally transferred. And again, we get some very small font here because we're talking about the constraining estimates of variable consideration. In a nutshell, the entity concludes that it is probable that a significant reversal in the cumulative amount recognized will not occur when the uncertainty is resolved. And this is, basically based on their history with similar products, et cetera. So they're able to get over that constraint. And in that case, they would be able to recognize revenue for the 80,000 units. What strikes me in that example is that very well may have been an example under legacy GAAP where a company may be required to account for that as a sell-through, i.e. they don't recognize any revenue until the product is sold by its customer. What might trigger that would be the price not being fixed or determinable because of the price concessions that normally take place there. So we have an example here of where, again, under legacy GAAP, it may not have been recognized until a point in time that is sold by the distributor in this case. But under the new guidance, it can be recognized at the point of sale. So then in case B, we have an example where the estimate of variable consideration is constrained. So in this case, the entity also has experience selling similar products. However, the products have a high risk of obsolescence. Also, the entity has experienced high volatility in the pricing of its product. So observable data indicate that historically the entity grants a broad range of price concessions ranging from 20 to 60% of the sales price for similar products. Current market information also suggests that a 15 to 50% reduction in price may be necessary to move the products through the distribution chain. So to estimate the variable consideration in this case, the entity again uses the expected value method, and the entity estimates that a discount of 40% will be provided, and therefore the estimate of the variable consideration is $60,000. And that 40% is basically that's a factor of the 20 to 60% of the entity's historical experience with this product. Then we get into the constraining estimates of variable consideration on the next slide to determine whether some or all of the $60,000 can be included in the transaction price. And based on the factors lined out there, the consideration is highly susceptible to factors outside the entity's influence, so obsolescence, for instance, and is likely that the entity may be required to provide a broad range of price concessions to move the products through the distribution chain. Consequently, the entity cannot include the estimate of $60,000 in the transaction price because it cannot conclude that that is probable that a significant reversal in the amount of cumulative revenue recognized will not occur. So to continue on with the example then, although the entity's historical price concessions have ranged from 20 to 60%, because that market information currently suggests that a concession of 15 to 50% will be necessary, and the entity's actual results have been consistent with then current market information in previous similar transaction, the company concludes that it is probable that a significant reversal in the cumulative amount of revenue recognized would not occur if the entity includes the $50,000 in the transaction price. So ultimately, where we kind of loop around on this example is that even though there is, in my mind, a broad range of pricing within this contract or estimated pricing, ultimately $50,000 would be included in the transaction price and would be recognized either at a point in time or over time, depending on how the goods are provided to the company. Okay, another example for consideration that is payable to a customer. So in this case, an entity that manufactures consumer goods enters into a contract to sell goods to a customer. Is a large global chain of retail stores. The customer commits to buy at least $15 million of products during the year. The contract also requires the entity to make a non-refundable payment of $1.5 million to the customer at the inception of the contract. The $1.5 million payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. So the entity considers the guidance and concludes that the payment to the customer is not in exchange for a distinct good or service that transfers to the entity. This is because the entity does not obtain control of any of the rights to the customer shelves. As a result, the entity determines that the $1.5 million payment is a reduction of the transaction price. So instead of the ultimate revenue being $15 million in that example, it ultimately will be $13.5 million because that $1.5 million is required to be accounted for as a reduction to the transaction price. And the next slide just provides kind of the nuts and bolts as to how that would be accounted for without the contract. Basically, the entity is going to reduce the transaction price for each good that is sold by 10%. Calculated at 1.5 million divided by the 15 million. So in the first month, the entity transfers goods to the customer. The entity recognized revenue of 1.8 million, which is 2 million of the invoice amount, less the 0.2 million of consideration payable to the customer.
We have our next polling question. Our organization in determining transaction price will need to consider the following: variable consideration, significant financing components, non-cash consideration, discounts or warranties, multiples of these issues.
Okay, so by and large, the answer was a multitude of these issues.
And we did have one question come in, Craig, while you were speaking. It says, what defines transfer of control? What is the definition of control?
I hate to do this, but I am going to defer that because as we get into the next two steps, it really goes through a lot of determinants as to when control is transferred. For instance, one industry that is going to be largely impacted by the standard is the construction industry for sure, where percentage of completion accounting has traditionally been very pervasive, and in looking at whether control is transferred as you're, for instance, building a house, that becomes very, very tricky. So I think I'd like to go through those. So hopefully whoever asked that, if you're not going to be on the next session, then I'm happy to get with you separately and kind of go through that. But it is a big topic.
Okay, and we have everyone's contact information, so we can kind of direct you to him.
So just a recap from what we've covered today. We talked about the general concept, the general objective of the standard, and then also the transition date, transition method being two very critical aspects. In step one, talked about, do you have a customer? Also, do you have a contract? Step two, covering performance obligations. And then in step three, covering how much revenue to recognize. As we move into the next webinar, step 4 then is how to allocate the transaction price, and then recognition of the revenue when the performance obligation is satisfied. And that's really where we get into the concept of control being transferred, is when do you recognize revenue? And I mentioned the percentage of completion example. That does not necessarily go away, but the terminology for actually, I think all elements of that will change. So now we'll be talking about recognition over time or recognition as of a point in time, and those kind of phrases will replace what we know currently as percentage of completion and completed contract.
Okay, and we have one more polling question and then some questions that have also come in. I plan to attend the next session in the revenue recognition series on October 5th. Please select yes or no.
Okay, so that's good.
Very good. All right, so we will begin with a few of the questions that have come in. Is it possible that contracts contain situations where only part of the revenue is recorded under ASC 606? It is very possible that that could happen. situation might be is if you're selling a good or service that is attached to a guarantee, you'd have to really break that apart and address the guarantee situation under its specific accounting, and then address the components within your contract that fall under ASC 606.
Okay.
Another question has come in, and please use the Q&A feature to ask these. As a private company, when should I begin the process of implementing these new standards?
So for private companies, and kind of remember back to the beginning when we talked about the implementation dates, for a calendar year private companies, the standard will be effective really beginning January 1 of 2019, unless you were to choose to early adopt. With that is just, well, it's a year and a quarter away, and I would have to recommend that process really should begin now or in the near future, certainly no later than during the year of 2018. So, basically what are you doing during that time frame is developing a plan to adopt the standard, determining how it's going to impact you, reviewing all of your contracts, and also determining, trying to make a determination as to which transition method to take. So if for instance, you were to do a full retrospective application, then in that example, you may want to be accounting for the revenue separately during 2018, so you already have the information captured.
Okay. We had another question come in. Regarding two separate promises being combined into one performance obligation. Let's see, I think they're finishing it. The presentation discussed biotech and technology companies. What about oil and gas? Is there any specific issue there?
So what was the first part of the question?
Two separate promises being combined to one performance obligation. We discussed biotech and technology, and he's wondering about oil and gas, if there's any specific issues.
I guess my best way to answer that is yes, there are, and neither Michelle and I are oil and gas partners.
Okay.
So I would like to actually, I hope to get Jake in here, but we can defer that and get back to anybody that's interested in the oil and gas concepts.
Okay, we can give that contact information on. With the right of return, is that accounting different than setting up a returns and allowances account that offsets revenue?
No, fundamentally no. What may be different there is the methodology for application. Actually, something I was reading here recently is, just kind of go into this, is while the treatment for rights of return may not significantly change practice under legacy GAAP, some of the notable differences is basically treating that as variable consideration. So now you have to go through the process of applying that variable consideration, including the constraint on variable consideration. So it has to be probable that you can estimate that. And then separately presenting the right of return asset and refund liability on the balance sheet would be a change in practice from legacy GAAP. So that would be the other change for the right of return.
Another question that's come in. If we determine that two separate promises in the contract should be combined into one performance obligation because they are highly interdependent, but we continue to charge the customer separately for those promises, can we apply separate revenue recognition logic to each revenue source?
Well, it sounds like they're separately identifiable in the contract, but you haven't met the criteria in terms of being distinct themselves. And so I think under revenue recognition, you would ultimately likely end up having to combine those in your methodology of recognizing revenue. Again, happy to go through your company's specific items with you and discuss it and go through it in more detail. But with the information we're given here, that would be my quick response or my gut response.
Okay. Good questions. Keep them coming. How much disclosures is required under a prospectivity? Prospectively.
So the modified. Oh, can you reread that?
Yeah. How much disclosures is required under a prospectively?
So an ongoing base. I'll answer. I think I understand the question. You know, going forward past the first year of implementation, because there's obviously going to be specific disclosure requirements in the year of implementation, as there would be for any new accounting standard. And to think about how pervasive these changes are going to be, that disclosure on its own is going to be rather robust. So I think the question is how much disclosure outside of that would be required on a go-forward basis. And the answer to that is it is substantially more than is currently required. Just the base level of disclosure requirements is substantially more than what's in current GAAP requirements, which honestly under current GAAP is very minimal when you think about what's required for your revenue recognition disclosures. Now, that is going to be different for public versus private companies. The biggest example for that is for public companies, there's a requirement to present disaggregated information regarding the various revenue streams. So this could break things out. You know, it goes beyond segment information, and you may break it out by geographic region, product line, et cetera. But that type of disclosure, you know, I could see that being potentially a half page or a full page of footnote just for that one requirement. I think by and large, you know, I'm expecting most companies probably you're going to have about a full page disclosure. Would you think, Michelle?
I would say 1 to 2.
Yeah. That's on the ongoing basis versus what traditionally has been sometimes a rather generic disclosure as to this is how we recognize revenue.
Okay. We have another question. It's kind of connecting to the new lease standards. From my understanding, even though the revenue states to follow the lease standard for leases, the lease standard reverts back to the revenue standard for the non-components of the lease. If this understanding is true, can we still show the maintenance on the lease as part of the retail/lease line on the finances, but then broken out in the disaggregation disclosure?
So the understanding is very accurate. It's kind of a circular equation that the lease standard does loop back. I mean, even though leases are exempted out of scope from topic 606, as we saw at the beginning, then as you get into the new leasing standards, it refers you back into topic 606 anyway. As to that very specific question, I think I would need to look at the specifics to answer it. I'm a little afraid to answer it off the top of my head, if that makes sense.
No, that's good. We have a few more questions before the end here. What happens if all the promised goods or services are not considered distinct?
So if you have that situation, you're going to have to combine all of your performance or all of your promises together for one performance obligation. You can reassess that at each reporting period, really evaluate if any circumstances have changed to allow to break out some of those promises into separate performance obligations. But otherwise, they would remain combined all the way until the end where the transfer of the good or service has been performed or the contract is terminated. Situations like that. So it may become a situation where it's limiting in terms of allowing you to recognize revenue until the end of the project.
Okay. I think we'll have our final question here. What are some of the specific AICPA industry task forces?
Okay, so for that, I should have brought the actual website, but it can be found on the AICPA's website. If you just look for the revenue recognition, it has its own kind of tab at the top. But the specific industries that they formed a task force on, you've got aerospace and defense, airlines, asset management, broker-dealers, construction contractors, depository institutions, gaming, healthcare, hospitality, insurance, not-for-profit, oil and gas, power and utility, software, telecommunications, and timeshare.
Okay. Well, we want to thank everyone for attending. We understand there was some audio issues that we worked with ReadyTalk throughout, so we appreciate your patience with that. We just want to let you know that the speaker line and the recording were not affected, and this webinar in its entirety will be available on our website later today, as well as in an email you'll receive when it's over. We want to thank you for attending. You will be directed to a link at the end of this presentation to complete the CPE form online. Once you complete that link and we receive your information, we will then be issuing a CPE certificate for you. We will be working on that today. If you have any questions, please feel free to let us know. Otherwise, you'll be contacted later. And we thank you for attending and have a great day.